are a lot of different types of saving and investment accounts available in Canada, and we've already talked about the TFSA, the RRSP, the RESP, and the RDSP before on our channel. But there's one more type of account that doesn't always get talked about, and that's the trust account. Now, trust accounts are definitely a little bit different than those other registered and also tax advantage accounts that I just listed off right there and mentioned. Like if we take the TFSA, for example. Whatever bank or financial institution you go to open one up at, you just say that you want to open up a TFSA, and it's pretty much the same process everywhere. But there's a few different types of trust accounts. And before we go too much further here, if every single time I say the word trust, you're just picturing the classic trust fund baby and you're thinking to yourself, aren't trust funds just for people who are really rich? And isn't it for just passing down like millions and millions of dollars to your kids? We're gonna stop that thought process right here because no, even though trust funds are used by the super wealthy, they can also be really useful tools for lots of different people. And like I said, there's different types of trust accounts too. And that's exactly what we're gonna cover in this video. What even are trusts? What are the different types of trusts available? Why would you use one and when? Also, how does it work and how would you open one up? You'll know the answers to all of those different questions and more in just a few minutes. But first, please give this video a big like down below because it really helps out our channel, and then we're gonna jump right into it.
So what even is a trust? To keep it really simple, guys, a trust account or a trust fund is a vehicle for passing assets from one party to another. And assets honestly could mean anything from cash, a house, other real estate. It could be even an investment portfolio that's already set up. Those are just a few examples. Now, to give you guys a visual here, picture a trust account as a moving truck and the assets, let's say money, investments, stocks, whatever, as the furniture being moved. In this case, the moving truck is taking all the stuff from inside, from you to someone else who you want to give those items to. Now, this kind of brings us into talking about who's involved in a trust account. There's actually 3 different parties or people involved in every trust, so let's break that down. Number 1, we have the grantor. This is the person who has the home, the cash, the investments right now, or the person that's packing up the moving truck with their stuff. They're also the person who decides all the rules for the trust, so for example, like what they want to do with it, for how long, how much should be paid out, but we'll circle back to that in a bit. Number 2, there's the trustee. This is the person who's in charge of operating the trust portfolio based on what the grantor said they wanted in their rules. So the trustee is basically the person driving the moving vehicle and making sure that everything goes to plan. And number 3, there's the beneficiary. This is the person who receives what's in the trust account or the people at the destination who get to unload the moving truck and keep what's being given to them. So quick summary here. A trust account includes assets from the grantor who creates the rules for the trust, and then it's managed by the trustee and distributed to beneficiaries as set out in the rules. Another way that we've heard all of this described that I think can be really helpful is thinking of the trust and the trustee as similar to like a small company that handles your money, and then the rules in the trust that you create are like the handbook for how to actually run the company.
So let's start talking about different types of trusts. High level, there's both formal trusts and informal trusts. And you can think of formal trusts as the ones that typically always involve a lawyer. And they also require very specific legal documents like a deed of trust. Now, informal trusts, on the other hand, don't need this document, but we're gonna talk about that type in just a second. First, let's stick with formal trusts. And there's also 2 different types within formal trusts to explain here. So number 1, there's what's called testamentary trusts. Now, this is specifically for when the grantor or the person who's setting up the trust is actually dead. Now, this might be what you think of the most when you hear the word trust to begin with, because basically the concept is that a parent's dying and they leave money for their kids in a trust to use after they pass. It typically involves the will too. So basically the rules for the trust would actually be included in the person's will, and that's where it would say what's in the trust, so at homes, money, investments, all of that, as well as who will receive those things, who's gonna be the trustee, and also how the rules and how all of it's just basically gonna work. And number 2, there's also what are called inter vivos trusts or a living trust. Now, this type of trust account is specifically used when someone's still alive, and they also want to dictate how their assets are being used and spent and distributed, all of that while they're still alive and doing well. Now, also, someone might use this type of trust to get different tax advantages too, so that's another reason. So quick summary of the formal trusts. They're typically set up by lawyers and they involve a deed of trust. There's 2 different types, one for trust post-death and also one for someone who's still living. Now, you can also use them to distribute assets or for getting tax advantages. Then there's also what are called informal trusts or in-trust accounts, but they're also sometimes referred to as ITF for short. Now, the informal trust accounts are definitely a little bit different. They're typically more like a savings or an investment account that you open by someone for the benefit of someone else, like a parent opening it up for a kid, for example. And then the reason that they're informal is because you don't need that same legal deed document. Instead, the actual contract or rules that are outlining how this trust is going to work, it's actually an investment or account document from the bank or financial institution that's involved in setting this account up for you. Now, to make that part super clear, there's no lawyers, no legal documents. Instead, you'd go to a bank, for example, and open up an in-trust account. And the investment or account details when you open it up, that would be the only formal contract that's involved in this one. Now, once an ITF is opened up, the grantor can put money in it, or they can buy investments within the trust account with no limits on the beneficiary's behalf. And if the beneficiary is a kid, then once that kid turns 18, you can start withdrawing money from the account, but only for it to be used for their benefit. The reason that people might actually choose to use an in-trust account is because there's no specific purpose that you've got to use that money for. Like, for example, how an RESP is just for education. An in-trust account could be used for other savings purposes too, or it could be used for additional savings for a kid's education on top of the RESP, just as an example. Now, another really important thing to keep in mind here is obviously taxes, and also ensuring that if you open up an in-trust account, you also understand how to optimize the taxes that you'd be paying. Now, I'm just gonna go over the high-level basics right now, but definitely make a note to do more research on this point if you want to open up one of these accounts.
So in general, in-trusts aren't tax sheltered like an RESP, tax-free like a TFSA, or tax deductible like an RRSP. But there can still be tax advantages, which once again is actually one of the biggest reasons as to why someone would even choose to open up an ITF, especially on behalf of their kid. To kick things off, one of the biggest benefits is that all capital gains, so the value your investment gains if you were to buy investments inside of a trust, and once again, high level, if you have no idea what I'm talking about, let's say you put $10,000 into a trust and you buy ETFs. If those ETFs grow to $50,000 in value, that $40,000 that's gained, that's called capital gains. And what's great is that those capital gains are then taxed at the child or the beneficiary's tax rate. Now, this is great because it means that they'll pay little to no taxes on that money, which is amazing. Now, the other type of money that you could earn on your investments is what's called income, which would be, for example, interest payments or even dividends paid out. Now, those two things are sometimes taxed at the child's rate, sometimes at the grantor's rate, or in this example, the parent's tax rate. And once again, we'll put up a chart up on the screen that goes over when and why this would actually differ. So on top of formal and informal trusts, these trusts can also either be revocable or irrevocable. Revocable trusts are specifically when the grantor, and again, the person who actually opened up the account, is alive, and it can be changed, amended, rules taken out, added in, and it can even be completely terminated if the person's alive. Irrevocable trusts, on the other hand, cannot be changed, altered, or anything like that. Nothing can be added in or taken out, and it cannot be terminated when the grantor dies. Basically, if you choose this option, the trust is drafted up, the rules are set, and then once it's established, that's pretty much it. It'll look the same no matter what. Also, revocable trusts become irrevocable once the grantor dies, something that's really key to keep in mind here. So let's do another quick recap here. When you're alive, you can choose a revocable or irrevocable trust. And then once you die, the trust will become irrevocable either way. So obviously the obvious question here is, why would you even want an irrevocable trust to begin with? Wouldn't you want the ability to change it up potentially? Or what if something happens in your life and it changes? The quick answer comes back to taxes and saving money. If you have a revocable trust, the one that can actually be changed, then the assets are still part of the grantor's estate, and therefore you would be taxed on any income that comes from the money or the investments or anything that's actually in the trust. But if you lock it in and you use an irrevocable trust, then those assets are looked at as part of the trust itself, and it isn't part of the grantor's estate, and therefore they won't be taxed on the income generated. So irrevocable trusts, they have tax advantages but can't be changed, and then revocable trusts don't have the same tax advantages but can be changed.
So now you know what trust accounts are, you know the 3 different parties that are involved, you know that there's formal and informal trusts, you know that your trust account could be either revocable or it could be irrevocable. But do you understand why you might want to open up one of these accounts? Now, on top of being used for people with a substantial amount of money to pass things down, there's also low-cost trusts, like informal trusts as an example, that could be used to protect whatever you do own and also give you peace of mind by making sure that your money, your home, again, basically any assets that you have, no matter how small it feels, actually goes to the people in your life that you want them to go to, whether you're alive or once you actually pass. And you can also use them to help save money for your kids on top of the other registered investment accounts that they have available to them. Now, another good example of the time that you might want to open up a trust is if you have a child with special needs and if they'll need long-term care. Now, if you're aging, having a trust account for them can really give you that peace of mind again, and it can also just be really, really helpful. Now, if you do want to go ahead and actually set up a trust account, depends on the type you want to set up, but you can start by either contacting a financial institution and seeing what your options are available to you. And if you decide to set up an informal trust, then the process is usually going to involve completing an account application that's similar to what you do to open up any investment account. And if it's a formal trust that you want to open, in that case, you need to get in contact with a lawyer who assists with trust accounts specifically. Now, something else that's important to know when it comes to trust accounts is understanding how your money is insured and also protected. And that's where CDIC comes in. Now, we're working with CDIC, or the Canada Deposit Insurance Corporation, on this video again. And before we dive in, we want to give them a big thank you for sponsoring this video and also helping to share all of this information with you guys. Now, in general, CDIC is a federal crown corporation, and they were created by the Canadian government in 1967 to insure bank deposits up to $100,000 per category that are held at any of their member Canadian banks or federally regulated credit unions. Now, you also automatically have their protection, so you don't need to sign up at all. Trust accounts or deposits held in trusts are one of the 8 categories that they insure, and they also specifically protect eligible deposits held in trust separately from the other deposits held by a trustee or a beneficiary in their own name. So basically, your trust has separate protection from your other money and other bank accounts. So this also means that the protection for trusts is separate from the protections for other registered plans like the RESP or the RDSP. Now, this is the case as long as there's a valid trust in place, and it can be formal or informal. And also if CDIC's member institutions have all the required information that they need about all parties, including the trustee. Now, to make that part really clear for you, if the financial institution doesn't have the information about the beneficiary, then CDIC will only protect up to $100,000 in the name of the grantor. But if they do have the info on the beneficiary too, then CDIC will provide protection of up to $100,000 per beneficiary. So that means that if you're a trustee with trust deposits for 5 different beneficiaries, those deposits are protected separately up to $500,000 total. Now, for more information on CDIC and how they protect your money in trust, make sure you check out their website linked in our description box below.
All right, guys, that's a wrap on this video. And once again, a huge shout out to CDIC for working with us on this video, as well as all of our other past Canadian account videos. Yeah, this is actually the end of the series for now. If there's any other videos that you guys want us to cover, any other accounts that you guys want us to cover, obviously we'll do our best to make sure we cover them in the future. And yeah, if you haven't already, like down below, make sure you like the video, of course. Make sure you subscribe right there in the corner. And if you haven't already seen any of our previous videos, make sure you check them out next door. We will be back. You know the vibes. Let's go.